Hey gang, this is Michael. I wanted to shoot a video to explain a scenario that just came up. I've got a client, potential client by the name of Brian, who is contemplating keeping his traditional mortgage, which he owes about $510,000 at 4.75. He took it out a year ago, so he's got 29 years left. And one thing that he's contemplating right now, and he wants to see the math on, is he's wanting to do biweekly payments, which he's not currently doing now, but wants to look at doing in the future and continue doing that. Now, biweekly payment does absolutely speed up a traditional mortgage payoff, but it's not nearly as beneficial as one might think. One, it's going to take some discipline. So you have to do biweekly payments consistently. And for every 5 years that you're doing that, it's essentially going to knock off 1 year off of your mortgage. So again, he owes $510,000 at 4.75% with 29 years left. And let's look at the math of that scenario first. So with 29 years, here's an amortization standard. Obviously, it's going to take him 29 years to pay it off, but biweekly, he's going to get it paid off in 25 years. So it's going to knock off 4 years, roughly 4.5, 5 years off of his current mortgage. So again, that's a biweekly payment at 4.75%, $510,000. He's got 29 years left. If he does biweekly, he'll get it paid off in a little over 24 years. So it will save him 5 years, which is a substantial amount of money. It's going to save a lot of interest by doing that. You know, as you can see here, his total interest paid to be $353,000 versus $430,000 of interest over that time period. So he's going to save about $80,000, really $77,000 of interest. Now let's take a look at the competition. Using a home equity line of credit like it's your checking account. Now one thing you need to know about Brian is he's got $8,000 of cash flow positivity. So at the end of each month when he pays his bills, he has $8,000 left over. So again, let's take a look at a home equity line of credit. $510,000. Home equity lines of credit right now have lower interest rates than mortgages. However, I do think that the interest rates are going to climb after this year. So I've built in here a 0.5% increase in interest rates every single year. He has net monthly income of $8,000 after paying all expenses. So as you can see here, he's going to have his home equity line of credit paid off in 73 months. So basically 6 years in 1 month. Far faster and more beneficial and a lot more savings by doing that. Now one could argue, okay, he's got $8,000 cash flow positivity, he could dump that towards his mortgage. This is true, but you cannot have a single hiccup. And although it would still take longer by doing a traditional mortgage than doing a home equity line of credit, you cannot have or afford a single hiccup. So if transmission goes out, you're basically putting all of your money into a traditional mortgage and it's in the bank's treasure chest. You cannot get that money out. So zero flexibility. So as you can see, that a home equity line of credit is not only faster, but it gives you a better insurance policy or flexibility in case life does happen, and it always does. Take care.